Hello, this is Chad Stayskull, President of Eagle Wealth Management, and I want to welcome everyone to the 2018 Halftime Report. We're happy to have you joining us today for this presentation, and we look forward to sharing some timely market information with you. First off, I'd like to draw your attention to these disclosures. I need to do what I can to keep the regulators and attorneys happy. Our goal today is to walk through some market fundamentals from the first half of 2018. Of course, it would be impossible to cover everything that happened so far this year. We believe, though, that tuning out the talking heads and focusing on market fundamentals will give you a clearer picture of the economy. Today, we'll look at where we've been, where we are, and what may lie ahead. This broad view may help you stay informed and give you a better understanding of the perspectives guiding our investment process. With that said, here's what we'll cover today. We're going to review the first half, talking about the U.S. markets. We're going to take a closer look at what drove U.S. equity market performance, and then go through a little bit of second half forecasts, talking about what's going on with the fundamentals. Let's begin by reviewing how the markets performed during the first half of 2018. Here is a snapshot of the Standard & Poor's 500 index performance for the first 6 months of 2018. The S&P 500 index tracks the market capitalization of the 500 large domestic companies. This index is a common benchmark for analyzing performance of the U.S. economy. The S&P 500 ended 2017 at 2,674 and closed June 29th at 2,718. This marked the 8th year in a row when the S&P 500 had positive performance for the year's first half. In fact, the economic recovery is now the second longest in history and may go on to break new records. But the continuing growth included some increasing volatility along the way. In January, markets hit new highs before tumbling back to earth in February. By February 9th, the S&P 500 was in correction territory, which means it had dropped more than 10% from its previous high. Of course, one topic dominated headlines through the first half of 2018: trade. You can see from this chart some of the major headlines and see how the S&P 500 reacted for the first half of the year. Trade and tariffs will likely continue to be the hot topic this year, and we'll go into these details later in the presentation. But don't get caught up in the headlines. We believe staying focused on the fundamentals and not overreacting to marketplace hyperbole is the key to financial and mental health. Each year, various media outlets compile many of Wall Street's top analysts' predictions for the year ahead. These are January's numbers. As you can see, their 2018 estimates cover over 750-point range, from 2,350 to 3,100, proof that even the experts often have differing opinions. While the results vary, one trend is consistent. All but one analyst predicted the S&P 500 would continue to rise in 2018. Of the analysts we've included here, their average estimates of 2,863 equals 7.1% growth. How did the predictions compare to reality so far? The S&P 500 finished the first half of the year at 2,718 for a 1.7% increase over the start of the year. In other words, we're seeing positive performance, but the S&P 500 has experienced less than half of the growth predicted for all of 2018. We're going to walk through some of the driving forces from Q1 and Q2 and revisit these numbers later in the presentation. Now, let's look at some specific economic sectors to better understand how we got here. To put today's economy in perspective, let's look back to December 2008, when we were in the midst of the worst financial recession in 80 years. Here you see 20 speedometers representing 20 leading financial indicators. 15 of the 20 are red, which correlates to negative or weakening numbers. The solid arrow represents where the financial indicators and the dotted arrow represent where the forecasts are seeing that indicator going over the next 3 to 6 months. There's a lot of red on this screen, right? By comparison, in January 2018, 17 of the 20 leading financial indicators reported positive or strengthening numbers, and those appear in green. We do see yellow in the political environment and equity market valuation. Geopolitical risk is the only red on the screen. In June, the speedometer showed a similar positive perspective. From the U.S. economic outlook to inflation to housing, most of the speedometers are green. According to City National Rockdale, which creates these charts, indicators show widespread strength and continue to signal modest U.S. economic growth ahead. As you saw in the previous two slides, geopolitical risk is the area of our economy currently in red. One major contributor to that risk is the trade tension we've experienced so far in 2018. A brief background. For years, the U.S. has had unbalanced trade relationships with China. From pirating our technology to charging us higher tariffs, China enjoyed significant leeway as we encouraged its economic development. The Trump administration believes China's economy has grown enough to handle more equitable trade agreements. As part of this push, the administration has added new tariffs to imports from China. In return, China has retaliated with its own tariffs on our goods. China is not the only trade relationship the Trump administration is reevaluating. Steel and aluminum tariffs are now affecting many countries, including some of our key trading partners, such as Canada and the European Union. They are now promising retaliatory tariffs in response. No one knows for sure how this trade tension will escalate into or if it will escalate into an all-out trade war. If it does, our economic growth could suffer. But for now, the markets haven't overreacted to the headlines. Instead, they've largely chosen to focus on more fundamental details. We all know that geopolitical headlines have dominated conversation in 2018. But another, less flashy topic has driven market performance so far this year: corporate earnings. First quarter earnings were especially strong. 78.2% of the S&P 500 companies beat their earnings estimates. They also averaged a whopping 26.6% increase over the same time last year. Companies released their second quarter earnings in July, and analysts expect another similarly strong performance. Recent estimates predict an average of over 20% growth in year-over-year earnings. Corporate earnings have been on the rise since the third quarter of 2016, and analysts expect at least several more quarters of positive performance ahead. The Federal Reserve aims to create a monetary policy that supports maximum employment, stable prices, and moderate long-term interest rates. As it works to uphold this goal, the Fed watches inflation to determine how and when to adjust interest rates. It uses the Index for Personal Consumption Expenditures, also known as the PCE or PCE deflator, as its primary source for inflation data. From the Fed's perspective, a 2% interest rate is ideal. If you look to the box inside the line graph, you'll see that both headlines of core PCE were at or above the Fed's inflation goals. The Consumer Price Index, or CPI, another measure of the economy's prices, is also above 2%. So far in 2018, the Fed has raised interest rates twice, and it's indicated 2 more hikes could occur later this year. When announcing the last rate increase, Fed Chair Jerome Powell said the U.S. economy is in great shape. Rising interest rates generally cool economic activity, thus lowering inflationary pressure as borrowing becomes more expensive and consumers tend to save more. The unemployment rate in the U.S. continues to be low. In May, it reached 3.8%, its lowest reading since 2000. The rate bumped up to 4% in June as more unemployed people began looking for work. Rather than being a negative indicator, this increase shows the previously disheartened workers are feeling good enough about their job prospects to re-enter the labor market. And 4% unemployment is still well below the 50-year average of 6.2%. Wage growth has also steadily increased as the labor market improved. We'd like to see slightly better wage growth, but it is improved nonetheless. All of these statistics point to a healthy labor picture. The University of Michigan Consumer Sentiment Index is one of the most widely used sources to help analysts set a grasp on how the average consumer feels about the economy. This is an important factor for consumer spending, which accounts for more than 2/3 of the economy. In March, the index hit the highest point since 2004. While concerns about tariffs affected some people in the most recent consumer sentiment survey, 2018's readings remain high. Even though a shortage of previously owned homes sent sales even lower, putting a squeeze on the real estate market, but nowhere near where they were before the crash. Home sales in May were 3% lower than a year ago. April sales were also down, but the median home price rose nearly 5% in May. Overall home sales are still trending positively. While home prices are rising, housing is actually becoming more affordable when you look at mortgage payments as compared to household income. According to the Housing Affordability Index, the average mortgage payment as a percentage of household income is at 13.4%, well below the 50-year average of 19.3%. Before we move on to our forecast for the second half of 2018, let's take a moment to revisit two different versions of the future we presented in our State of the Markets address in January. We showed hypothetical newspaper headlines for possible positive and negative issues. 6 months into the year, which storyline seems to be taking shape? Now let's turn to the second half of the year. Industry analysts in aggregate predict the S&P 500 will see a 13% increase in price over the next 12 months. This percentage is based on the difference between the bottom-up target price and the closing price of the index as of July 5th, direct from the link above the insight at .factset.com. While we can use these forecasts as a guide, we also understand there can be many factors that can change on a day-to-day basis. In the first quarter of 2018, the gross domestic product, GDP, increased by 2%, a bit lower than the 2.3% growth we experienced in 2017. But many analysts believe the second quarter reading could be much higher. Estimates have gone as high as 4.8% annual growth, while recent readings landed in the mid-threes. Even at that level, our economy would be growing faster than it has in several quarters. This chart shows the median projections from the Federal Reserve Open Market Committee. As you can see, it expects GDP to continue expanding at a relatively steady pace for the next few years. The increase over the 2% is mostly due to new corporate tax changes along with lessening regulations. But these changes are only expected to have an effect on our economy for a few years before we come back to that 2% GDP growth. As we discussed earlier, corporate earnings were strong in the first quarter. We haven't yet received the full reports for second quarter earnings, but recent estimates point to an average 20% growth for the S&P 500 companies. Analysts expect corporate earnings to continue to grow in the second half of 2018. In fact, we could experience continued double-digit earnings growth through at least the end of 2018. The Federal Reserve has already raised interest rates twice this year. It has also indicated that 2 more rate hikes could occur in 2018, with the possibility of 3 increases in 2019. After the June rate increase, Fed Chairman Jerome Powell expressed confidence in the economy's strength. He explained that people are finding jobs and both inflation and unemployment are low. At the same time the Fed is raising rates, it's also trying to unwind the $4 trillion in bonds it bought during the financial crisis. This unprecedented process, known as quantitative tightening, is beginning to affect bond markets. It could contribute to short and long-term yields becoming very similar, which can indicate slower growth ahead. We won't go into the nitty-gritty of the details here, but essentially, the Fed must address multiple goals as it moves forward. Raise interest rates at an appropriate pace, continue quantitative tightening, watch the bond markets closely. As it works to strike this balance, the Fed continues to believe the economy is doing well and plans to raise interest rates in response. Ultimately, rising interest rates are a sign the economy is doing well. But what exactly happens when interest rates rise? Let's look at the chart. This is still one of the most statistically powerful charts we have seen when it comes to how the U.S. stock market will react when interest rates are rising. The yellow dotted line represents a 5% yield on a 10-year Treasury note. Currently, the 10-year Treasury note is just under 3%. If you look at the placement of the brown diamonds, you'll see that most of the cluster in the upper left and lower right quadrants. This pattern shows us that when rates are below 5%, as they are today, equities tend to grow when these rates increase. But when rates are above 5%, equities tend to decrease in response to rate increases. In other words, history shows us markets may rise as rates increase, as long as they stay below 5%. Rising inflation and interest rates may negatively affect one area of the market, fixed income. On the last slide, we saw the correlation between rising interest rates and a rising stock market. The data also shows that this scenario can cause bond yields to rise too. While increasing yields might seem like a positive scenario, yields and prices have an inverse relationship. So, generally, the more bonds are yielding, the less your bond may be worth if you sell it prior to maturity. After experiencing years of low interest rates, many investors may be surprised to see their bonds can lose money if they are sold prior to maturity. Bond fund values may also decline during periods of rising interest rates. But a changing tide in the economy doesn't mean you have to abandon fixed income. Often, this movement is an important part of a well-balanced, diversified portfolio that provides an income to investors' needs. Instead, we pay closer attention to bond risks and opportunities and can keep an eye on inflation and interest rates in 2018. We will also continue to monitor the geopolitical uncertainty that can significantly affect fixed income yields. Tuning out political noise while managing your finances is not always easy. However, investing wisely involves more than reacting to soft factors like consumer sentiment or geopolitical tremors. For investing opportunities, we urge you to stay focused on the company's earnings and global economic data. In other words, we encourage you to focus on the fundamentals. We've gone over a lot today, but if you remember just one detail from our presentation, we hope it's this: emotions have no place in investing. Market corrections are not something to fear. They are a normal part of market cycles. If volatility feels especially uncomfortable for you this year, it may be because 2017 was unusually calm. This chart shows the intra-year lows each year going back to 1980 in brown and the annual returns in gray. Last year, we experienced only a 3% intra-year drop, coupled with 19% growth. Here you'll see that last year's performance isn't normal. Instead, volatility in the stock market is common. In fact, despite an average intra-year drop of almost 14%, the annual returns are positive for 29 out of the last 38 years. Could there be a correction coming? Yes. Should it derail you from your long-term investment goals? We hope not. If you ever feel concerned and want a better understanding of what's happening, lean on us for support. We're here to help you, and we want to help you make the most of your financial life. News outlets need to pull in viewers. They do it by turning minor events into breaking news headlines. This chart shows the S&P 500 price performance between 2004 and 2014 and the CNBC viewership over that same period. Do you see a correlation? Notice how viewership spiked in the stock market as the stock market fell during the financial crisis. People tend to focus on negative information and tune into media in times of crisis. On the other hand, viewership drops as market performance improves. In 2017, CNBC hit its lowest viewership in 22 years. Last year also happened to be one of the calmest markets on record. We know that this year is presenting many opportunities to question where the markets are going and what it means to you. But remember this chart the next time a talking head is yelling at you about current events. Drama may increase viewership, but the markets have other drivers. Tune out the noise. Let us filter through the headlines and keep you informed. We've talked about a lot of points today, and I'm sure some thoughts have emerged. At this time, feel free to give us a call, and we're happy to answer any questions you may have. Thanks so much for sharing some time with us today. We hope you enjoyed the information we shared. If you have any questions about this presentation or your personal plan, please do not hesitate to contact us. Once again, this is Chad Stacekel with Eagle Wealth Management signing off for mid-year 2018. Have a great second half of the year.